following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is, of course, the program where we break down the various aspects of options and options trading for you, the busy financial advisor and the busy financial planner, as well as for many of you who may be considering adding a financial advisor to manage your portfolios or is looking for a little bit more insight into this space. The Advisor's Option is the program for you. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. In fact, our latest addition to the old network is a program that I know is near and dear to one of my co-hosts on this show's heart. Of course, I'm talking about the Wide World of Options. It is the new program from the Options Industry Council, and it comes out through our Options Insider Radio Network, hosted by my pal Joe Burgoyne over there at the OIC. Check it out. It gives you, as the name implies, a very broad perspective on the world of options, a little bit of education, a little bit of analysis, some interviews, some look backs at the days of yore from an options perspective, and even some great book reviews and trading platform reviews and a lot of other great stuff. Check it out, The Wide World of Options. You can find it on the OptionsInsider.com or in iTunes, Stitcher, Aha Mobile, wherever your podcast provider of choice may be. And of course, joining me on the old program today, we have a nice full roster of co-hosts today, which always makes me excited. It means we'll have some great spirited conversation on the show. Starting off by way of distance, we'll bring in the farthest first. You know him, you love him. He is Eric Kott, the Managing Director of Advisors over there at the Options Industry Council, beaming in all the way from lovely and scenic San Francisco, California. Eric, welcome back to the show, sir.
Mark, always great to be here. Always great to be on the call with my colleagues, Randy and Mike. And actually in San Francisco, but even further out today, I'm currently in wine country. So it's a beautiful region to be in. But unfortunately, we'll be inside and not partaking in all the wonderful things out here. I'll be visiting advisors in this region.
I'm trying to think. I think the last time you were actually on the show, both you and Alan were beaming in from San Fran. So we seem to have a little San Fran thing going on with you on the show here these days.
That's right. That's right.
I think you're using your appearances on this show as an excuse to perhaps wrangle a nice trip to wine country. I can't blame you. I wouldn't mind doing the same thing myself. Maybe next show we'll do a live one from the wine train through Napa Valley. How does that sound?
We can do that, and then we can also host it from beautiful Durango.
I like that too. Speaking of beautiful Durango, we are also joined by my cohort, my partner in crime. He is, of course, the co-founder of Swan Wealth Advisors. He is Randy Swan. Randy, welcome back to the show, sir.
Thank you very much, Mark. It's great to be on here. It's not out in San Francisco right now. The fire danger is extremely high in Durango and southern Colorado right now, so there's literally fires all around me right now.
So certainly not perhaps as fun of a place to be right now as over in wine country in Napa Valley. But I think we'll make do. We'll have some fun here on the old program. Maybe that'll cheer you up, Randy. And keep your mind off all of this looming fire danger out there in Colorado. One nice thing about living right here in the center of the country in Chicago, we get tornadoes, we get all the other fun stuff. Not too much really on the fire perspective, so I think we're
What are you talking about?
We're good in that case.
Greatest fire of all time.
I'm talking wildfires, sir. Not these little city fires. That voice, dear listeners, belongs to none other than my other boon companion, good old Mike Cavanaugh from RCM Asset Management. You may recognize his voice from the able job he did yesterday, guest hitting for me, co-hosting on the old Option Block program. He is joining us again today, a rare double hitter for Mr. Mike Cavanaugh on the Advisors Option program. Mr. Mike, it's been too long. Welcome back to the program, sir.
Thank you, sir. And outside of 1871, the Great Chicago Fire, we haven't probably had anything similar to what's going on in Colorado. So, Randy, I hope you're safe and all goes well with the fires out there. And everything in Chicago right now, I mean, we're going to talk about options. It's going to be fun for an hour. But everything in Chicago is Blackhawks fever. You got it, Eric. Blackhawks.
Congratulations there, Michael, on that win. And obviously Mr. Kane deserved the trophy. And I would echo those sentiments to Randy. The Swan family and everybody else out there in Durango, our thoughts are with you because I flew over the area yesterday. And we're just hoping that things work out in a positive way.
Yeah, you could certainly, speaking on the Blackhawks, we live downtown, and we're, of course, headquartered downtown here in Chicago, and all night long, you could hear people just laying on their car horns pretty much 24/7 once the Blackhawks won. It was just a big party here in downtown Chicago. So interesting stuff. All right, and speaking of the Blackhawks, it's time to keep on shooting right on into the Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, listeners, welcome to the Tricks of the Trade segment. This is a segment where we like to take some aspects of the options market and of options trading and teach you interesting ways to apply them in your own practice. And today we're actually taking a little bit of a different approach even from that. We're looking at some things that a lot of advisors do on a regular basis in their client accounts and in their customer accounts, and taking a look at it from an options perspective and maybe some of the pros and cons of that particular approach. Of course, we're talking about annuities and structured products and kind of lumping those all together for our discussion today, even though they are two very different things. But the concept of annuities and structured products, if you're an advisor, you're a CFP, or if you're a client who has an active advisor, a lot of advisors like these products. They're very simple definitions for those of you who aren't familiar. Structured products are very simply any sort of product that, for our perspective here on the show, attempts to replicate some sort of options functionality, perhaps a covered call, perhaps a protective put, and puts it all together in one product where the advisor doesn't have to do it himself. It is done for him in this product, with a variety of pros and cons that we're going to outline here. And of course, annuities, I'm sure most of you are familiar with annuities, these products that just provide, in exchange for an upfront payment, a steady income stream for some specific period of time. We're going to focus on the structured products first. Annuities tend to fall into that bracket as well, but we'll get to them a little bit later. Structured products from an options perspective are really one of the, I suppose you can call them an obstacle, an impediment, or roadblock for options penetration into the financial realm. And quite frankly, it's because so many advisors have just been trained over the years to really gravitate towards these products for a variety of reasons. It could be just the very basic fact that they don't really understand options very well, so they find these structured products to be an appealing alternative. It could also be very frequently the clients are reticent to utilize options in some way, shape, or form. So the advisor turns to these structured products as a way to appeal to and appease the client. It could be the fact that maybe this is a little less desirable, but it could be the fact that the advisor has an existing relationship with a provider of some sort of these products, and they lump that into that existing relationship. And of course, there's the ease of use factor that I cited earlier. A lot of advisors simply don't have the time or the wherewithal to manage options positions across a variety of client or customer accounts, so these structured products tend to facilitate that. So there's a lot of reasons people like to get into these types of products. Maybe before I keep going, we'll start with you, Uncle Mike. What's your perspective here on the use of structured products in the advisor space, particularly as it pertains to replacing options? So instead of writing a covered call for a client, you're going to go out and buy some, let's say, a covered call fund. Or let's say instead of writing or buying a protective put to hedge your downside risk, you're going to come out and buy some sort of structured product that replicates that. How frequently do you see that with your advisors, and what's your take on that in general in the advisor space?
Don't get me started. No, I think you got to be clear on the definition of a structured product, because there are some products out there, like when you mention a covered call, like a mutual fund that's replicating a collar or a covered call. Those are typically okay, depending on the management style. It's a good plug and play for a client that says, hey, I'm interested in this kind of exposure. An advisor can dial in to a mutual fund or an ETF that has optionability and create, a product in the portfolio that the client wants. That I don't have any issues with that. When you talk structured product, that's where my blood starts kind of boiling, because there aren't that many that I've seen that can't be mastered or done by the individual themselves, or where an advisor doesn't really understand the complexity of the structured product. And I could go example after example. The reverse convertibles back in 2008, 2009, they're still around, but they're not as prevalent because they're under a high amount of scrutiny right now. But they're called knock-ins, reverse convertibles. People are calling them a whole bunch of different things. But I've had a lot of clients that they'll get pitched by another advisor on a structured product like a knock-in or a reverse convertible that's basically just selling cash-secured puts and defraying part of the premium. If you can capture a 20% yield on selling a 10% out of the money put because the volatility is at 170 on one of the strikes that you're selling, what the structured product was doing is saying, well, we'll give you a guaranteed 20% yield on the product. The principal's not guaranteed. You own the stock if it hits your knock-in level, which is the short put level. Now, you got to read about 8 pages of disclosures before you figure out what they're doing. I look at a prospectus on a structured product as same as a warning label on a pack of cigarettes. If you get a structured product from an advisor, it basically says you should check with another advisor before you actually do this. Those are my thoughts. I don't think they're all bad, but I think if there's a warning label on a structured product that says here are the things you need to consider before, I think if you don't have the time or the information to make the informed decision on that prospectus, call your financial advisor and have him keep calling other financial advisors until he trips across a guy like Randy or myself that understand this stuff to say, that looks okay, or I wouldn't touch that with a 10-foot pole.
Yeah, I think the one you outlined is definitely the type of product that I'm thinking of as being the most onerous, the most egregious for the advisor space. The ones that replicate, or I should say really attempt to replicate, very, very basic option strategies like the short put, and then in turn charge you egregious
crazy
fees.
Those shouldn't be legal. I mean, I'm not the guy that should be making the decisions for the SEC, but
and Mike, I agree with you. And I think one of the things to clarify also, having been in an advisory role, Mark, and then also having worked for an annuity company, having both experiences with the two investments you're talking about. I mean, again, in the structured product or the SIP world, as we call it, the investment firms, having come from a large wirehouse firm that used to have a bull as their logo, they were, creating customized products, which Randy and Mike know very well. I think that one of the things that's appealing to a retail client who works with an advisor is, again, you have to understand the cost, as Mike said. You have to read the prospectus just like anything else. But one of the things that clients did prefer with this type of vehicle is that it at times provided that principal protection. And so, yes, there are inherent costs. It might not be the most appropriate for every client, but I always have to say, the investment world creates these things, and sometimes there are firms out there, surely, that might maybe abuse the marketplace and create things that clients don't always understand. I mean, and I think that goes back to the simple rule, of knowing your client, but also that the client needs to understand all of the nuances of that investment. And it maybe fit in for an advisor that isn't a do-it-yourselfer. It is an advisor maybe that is a general contractor and likes to sub out, because what they're good at is relationship building, and they work with their clients potentially on more of the, I would say more of the planning aspect than it might be the investments. And so, but Mike does bring up a good point that after 07 into 08, there were a number of these investments that inherently were supposed to do something, and they didn't, and it really caught clients on the wrong side of the fence, and that was a problem. So I think from the aspect of where structured products, SIPs, are at this juncture, and I see it out there in the field a lot, there are a number of advisors on the independent side and even RIAs that do gravitate towards that, because they have the implicit backing of a corporation. But then again, and Randy, you and Mark know about this, if we go back to 08, we do know there were two big firms out there that don't exist today. One that had the initials BS and one that was LEH, and they don't exist anymore, and they were in that marketplace of structured products.
Now, Eric, of course, now that you've migrated into your new role from the advisor space into the options evangelist space, I suppose you can call it, how frustrating, how much of an impediment do you see these structured products as being? Because now, of course, your new job is to kind of go out to the advisors and explain these products to them and the values they can receive from using, let's say, a covered call or a protective put. And how frequently do you encounter advisors who may push back and say, well, I already have this in X product here, and you can take a look at it and you realize that it is a markedly inferior product to just doing the strategy yourself? How frequently do you encounter that in your day-to-day meetings with the advisors these days?
Well, as Randy and Mike know of me, I'm clearly in the camp of being like Switzerland. I have to be very impartial, and I also know, having been an advisor myself for many years, there is an attitude of most wealth advisors that they tend to be fairly confident of what they're doing with their clients. So I would never disparage what an advisor is using. What I tend to do is open their eyes to firms, such as Mike, such as Randy's, that have professional managers that are able to oversee, the strategies, the overlays, the way that they can help out, instead of just gravitating towards one area, which is a structured product at their firm. Maybe the idea is that they can be in more control of the client's assets and add a more customized strategy, in terms of seeking out a sub-advisor manager that has the experience of utilizing options. And so the conversation, if an advisor says to me, yes, I'm doing it already in a structured product, then my first reaction is wonderful. And you're part of our congregation, and I'm glad to hear that. You're not just throwing me out the door and saying options are for fools, and that's a risky investment, and that's a whole other call or a whole other conversation of how I react to that. But when they say that they're using structured products, at least they've dipped the foot in the pool, and they're realizing the benefit of using derivatives. And that leads into another conversation of saying, if you only have 24 hours in a day and you are allocating your time in different ways to your client base, then maybe what might be helpful is seeking out someone that you can bring into your overall team, just like you bring in an accountant or estate planner. Bring in someone like a Kavanaugh or a Swan and say, hey, I've got clients that can really benefit from the professionalism and the experience that you have and still maintain that relationship, but have just a best of breed with sub-advisors like the two guys who are on the call now.
That's interesting. So you view them actually almost as a gateway drug to options in many respects. If they're already using a structured product that replicates some sort of option strategy, then they at least have had a sip or two of the Kool-Aid, and you think maybe you can give them the rest.
You know, Mark, it is a very frustrating and uphill battle to get the advisor community over that hump in terms of their acceptance. I mean, look, we know that, again, today, in 2013, we're actually celebrating the first listed option at the CBOE, but we're also celebrating, the OCC's anniversary in terms of clearing options. And so it's a fairly young industry and product, but there's just such tremendous resistance on the part of the wealth advisory community. And I think we talked about this, the four of us before on calls, that it really comes down to the fear and the frustration of an advisor not having that light bulb go off. So in terms of being on the same side of their desk with them and complimenting them, commending them for actually putting it into their asset allocation model is the first step in that conversation, and then being able to guide them into other ways because, again, advisors really kind of, they're the leader in terms of the relationship, and they want to know, just like the Chicago Blackhawks, who are, were in control of their own destiny, advisors are in control of their own client's destiny. But if we can kind of do a little bit of hand-holding, kind of show them that there are other ways to do it, then I think they really appreciate that.
And Randy, you have a little bit different perspective than Eric or Mike or myself here on this show because you actually have a product out there in the space right now in terms of a fund, actually. So you are active in this realm already. So you have a little bit of a different take on seeing what's going on out there in the structured product space. You probably may be bumping up against some of these other products that attempt to offer maybe one aspect of what you do or perhaps another, but perhaps they do it in a different or perhaps less efficient way. So it must be an interesting viewpoint for you going out there now with the fund and some of the other overlays you have and seeing other advisors who may be pushing back because they're using this structured product X or some of the other things that are out there. It's got to be an interesting perspective you have now on this space now that you've launched the mutual fund and gone down that road.
Yes, I agree with that. I kind of like what Eric said. I mean, we have advisors that use us but also use other structured products. I think a structured product to me maybe the best gateway for an advisor to get their feet wet a little and get into this space. And then as a money manager, we would come back to those guys and go through the pros and cons of the different products, and then say what our product, what we think it offers over and above the typical structured product in terms of cost and flexibility and stuff like that. So, we don't run in, most of the people that invest with us do not use structured products, but we definitely have several advisors that do. So I agree. I think it's a good way to start from that perspective and then help those advisors build on that.
The gateway drug to options use. I like that. But, I debated whether we should run through some specific examples and get into a lot of the detailed aspects of structured products, but of course that would take quite a bit of time. I think this is a good episode to perhaps lay the groundwork for a future discussion on some of these specifics and what you can do and what perhaps you should avoid with some of these structured products. But I think for us here, for an options perspective, there are a few things we should lay out for our listeners to keep in mind and think about when they're looking at using perhaps some of these products. Mike hit on it earlier. Of course, a lot of the products that we're focusing on here are the ones that are specifically designed to replicate some sort of options functionality. So definitely the first thing you want to do if you're looking at, let's say, one of those reverse convertibles or the knockouts that Mike was talking about or something along those lines, something that perhaps replicate a call, is of course look through the 8 or 10 or 50 pages you have. It's a bit onerous, I know, but you want to get to the meat of what that is trying to do. And typically when you do that, you can find what type of options functionality it is attempting to replicate. And the vast majority of these products fall into three categories: either replicating some sort of covered call income strategy, or perhaps a short put income strategy, which will get you long the underlying eventually, or some sort of hedging protective put strategy. Those are pretty much the three basic categories that most options advisor products tend to fall into. So bear those in mind. And then once you have an understanding of which kind of product you're actually looking at and what it's attempting to replicate, actually do a little bit of legwork. I know it's hard to tell that to advisors because they're so busy, but when you see, let's say, a product that's replicating a 5% out of the money covered call on the SPX or the SPY or whatever the case may be, take a little bit of a look and say, well, how does this actually replicate that versus me constructing that myself, me having the actual portfolio and writing the covered call myself? That is usually where some of these products tend to start falling apart, is in the actual accuracy and the efficiency in which they replicate the strategy that they're trying to actually produce for you. And then when you start factoring in other things on top of that, like fees, these things become much less attractive from a lot of different perspectives, because usually they are less accurate than replicating that strategy yourself or actually executing it yourself. And then you start adding in the fees and the other things, these products become much less ideal. Of course, if you are using these products because your clients or you yourself are somewhat averse to using options, that's a bit of a catch-22, because you're using a product that is, of course, using options for you. So then you really want to do your homework to see exactly what this product is using options for and how it's structured, because I think you might be alarmed to see exactly what you're getting into. It's sometimes attractive to just use the set it and forget it Ron Popeil model of you buy this structured product, you sit it in client X's account, and then you're done, when in reality there is a lot that's going on under the hood of these products that we need to be aware of. I know the attractive aspect of them is, of course, time management. You get to buy this one product, set it and forget it, and you move on to the next trade. As Eric was saying earlier, you can focus more on the relationship management rather than the actual day-to-day money management, which is attractive for a lot of advisors. But when you're starting to put these products that are laden with derivatives into client accounts when they perhaps are reticent to use derivatives to begin with, and on top of that they're expensive, and on top of that they're not really replicating the underlying strategy very effectively, then I think we need to really take a second look at what we're doing with these products. Maybe I'll go around the horn one last time for one last take on, we'll close the book for now on structured products. I think we'll save annuities for another day as well, because we can really get down that rabbit hole. I know we have some good questions from the listeners I want to get to too. Perhaps, Mr. Kavanaugh, we'll start with you. A final take, an overview on structured products and the advisors, and then we'll perhaps save some of our powder for a future show where we can dive into some really deep specifics on this issue.
Yeah, everybody made some really good points. I guess what I would leave the person that's looking at a structured product, just make sure you read the prospectus, which no one ever does. I read them on behalf of our clients. I'm more than happy to be that guy. But if you've got that guy already, Randy's one of those guys, send the prospectus of a structured product, or the term sheet of a structured product, to somebody you know, like, and trust, that is going to be able to decipher the information in there, so they can say, yeah, this isn't going to hurt you, or here's what you need to look out for. They can be a good entree, but it also will differentiate you as an advisor. If you take the time to understand what these structured products are, you might be able to help your client very easily over the structured product. And it is a set it and forget it type of product, but if you're able to help them, even more than the structured product, where it doesn't take that much time to replicate the structured product, why wouldn't you? Why wouldn't you take the time to understand what are the things that could go wrong, and then how do you best explain that to the client? So caveat emptor is always going to prevail in the structured product market. So take a little time to get to know what you're buying.
I've toyed many times, and I'm still mulling in the back of my head how to maybe do this the right way without being sued out of existence, but something along the lines of a bad product alert on the Options Insider, where we highlight some of these structured products that are just atrocious, and we say, you know what this is attempting to do. Here's how you could do this yourself, cheaper and better and faster. And I just don't want to.
You need a cape and a mask.
Yeah, exactly.
You're an anonymous person. You're derivatives man.
Exactly. I don't know how to go about that without having the crosshairs of every legal department in the industry on me, but I'm still mulling it over. But it's something we're thinking about here, because I know OIC can't go down that road, and a lot of other people can't go down that road. We probably can. So, and there is definitely a service to be provided there. I just don't want it to blow up the rest of the firm in the process. So we're mulling that over, and we've been mulling it for a while. If someone has an answer for that, please let me know. But next, same question for you, Eric. Let's wrap up here our discussion on structured products, and then we'll revisit it down the road a bit.
Yeah, Mark, I just wanted to add, because you brought up some great points summarizing the whole idea of SIPs. One of the strategies that is prevalent in the marketplace, especially by the larger firms, is a collar strategy. And I think that's where you see a lot of advisors. Advisors in the region around the country that are using structured products, because they'll add that collar position, obviously selling calls to finance the put. And you said, eloquently, Mark, that you really have to lift the hood, figure out where all the costs are, and see if it does maybe make some sense. And in terms of your point, Mark, about flagging or making a list of the potential products that are out there that might not be the most appropriate, would be difficult in the position that I am to go down that road with you. But I think that there would be value added as long as you're raising awareness, Mark, to advisors. I think they would greatly appreciate that. And I think that, it sort of, if there's the education side of it where you're noticing that there are certain things that maybe there's another way that the advisor could do that at a different cost and maybe in a different capacity, I think the advisor community would really appreciate that.
It's another reason why I didn't bring up any specific examples on this show. I know it would put you and a few others in some uncomfortable situations, so I thought I would hold that off for a future episode. But it is something, like I said, I have thought about many times about visiting, and I still want to revisit because it's clear there's a lot that needs to be done in this space to educate advisors on this particular issue and how they could so much more easily, or maybe not easily, but so much more effectively replicate these strategies themselves using the options in the underlying, and how they can do it without all these other fees and these ridiculous things like these knockouts that are writing a put for you and charging you exorbitant fees to do it and putting all the risk in your lap. These things are atrocious, and that people need to be educated on these products because it is doing damage to advisors and to their clients in the long run. So if we can just penetrate that a little bit, I think that would be an interesting thing. I just have no idea how that would work and how we would avoid the legality and all the other fun things that go with it. But it's an interesting challenge. I think we're up for it. So we're kind of mulling it over here at Inside. I'll let you know when we have more ideas on that front. Last but certainly not least, Mr. Randy, give us your final take here on the old structured product realm before we dive on into the old listener mailbag.
Yes. I guess what I would always do when looking at a structured product to me is maybe do some what if calculations and some expected return analysis, and then really try to compare those to other various actual option strategies out there and see the pros and cons and see how things fall out. And then also I would just also mention the default risk issues that of course exist when companies back a certain product.
Yeah, that's a good point, too. We're talking here with Eric from the OIC. He, of course, is a representative of the OCC, which is the Options Clearing Corporation. And all of the strategies, all of the options products we're talking about here on the show involve listed options products that are centrally cleared by the OCC. So you don't have what is referred to as counterparty risk. These are all centrally cleared. You have the OCC standing behind every options trade that you do. As Randy rightfully brings up, that's not really the case with a lot of these very elaborate structured products. These are built and designed by Firm X, and essentially you have Firm X standing behind that product. You may have a few listed options wrapped in there somewhere, and so those are cleared, but the product itself and the risk behind it is all pretty much guaranteed by one firm. So as we saw in 2008 and 2009, there was a lot of risk in counterparty risk in general. And that's why the government is debating whether bringing all this stuff onto centrally cleared repositories. There's a lot of interest in that space right now. And you as an advisor have skin in that game, because if you're using these structured products, you're very much on the fence for one of these firms. And if this firm that is creating this product for you is also turning around and blasting out puts willy-nilly like AIG was essentially doing, selling their credit default swaps, they may not be around to actually take the other side of that trade when you need them to, when that structured product actually pays off and your portfolio drops 5% or whatever the case may be, and you need them to pay off that hedge. They may not be there for you. So that's an interesting point and a good one, Randy. I'm glad you brought that up, because it is something that is certainly, if you're looking at doing this and you have risk-averse clients, certainly something you may want to consider. All right, that's going to do it for our introductory discussion of structured products. We're already running a little bit long, so we're going to keep on rolling right on into my favorite part of the show, actually, the listener mailbag.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the listener mailbag. As I mentioned, this is my favorite part of the show because this is where you, the listener, get your chance to sound off and make your questions and comments known for us here on the Advisors Option panel. First up is a question. We've touched on various aspects of it before, but I think it's got some timely elements to it, which is why I want to bring it up again. This is a question from Mr. Charles Sullivan. He writes, is the primary stumbling block for options use by advisors the fact that the leading names in the advisor space, and he mentions Charles Schwab and Morningstar, etc., seem to have no interest in these products? An interesting question. We've talked before. In fact, Randy and Mike and I were on a panel at the OIC conference over a year ago discussing this very topic in a very great detail. That landscape has evolved quite a bit. Of course, Charles Schwab has acquired Options Express, so they have this dedicated options arm. But you're right, still the advisor arm of Schwab and the Options Express arm of Schwab are still two very different entities, and they haven't really brought those two together in any meaningful way. You mentioned Morningstar as well. Eric, I was unable to make the big Morningstar Advisor show in Chicago. Did you go here a few weeks ago?
Yeah, I was there, Mark, and I think that I'll just really briefly throw a comment out to Charles and then let Randy and then Mike kind of add to it. But, the interesting thing is that Morningstar does actually have an options division there that Phil Guzik is overseeing, and they have incorporated that into this conference last week or 2 weeks ago in Chicago at their 15th annual conference, and they also have modules and such that advisors can pay a service to get their research. So more and more of the firms, including TD as well, are realizing that they need to take their retail platform, which is really more advanced than what they offer the advisor, and integrate that so the advisor has the same technology that their retail clients do. But I think we're seeing more and more of these independent firms and as well as larger brokerage houses understanding the benefit of allowing their advisors to use options in their clients' accounts. So I'll kind of turn it back to the other two guys.
Thanks. This is Randy. I couldn't agree more with this statement or the question. This is probably our biggest stumbling block, historically speaking. We've had many interested advisors wanting to use firms like ours and say, oh, I can get you approved at Schwab. I know someone at Schwab, and we always laugh about that after doing this for so many years, and they are still not really that interested in working with firms that use options on the more institutional platform. And it is really kind of interesting that, as Eric mentioned, that the retail platforms are probably, I don't think I'm exaggerating to say this, maybe 100 times more robust than the institutional platforms under places like Schwab and stuff like that. So, but I think it's gotten easier. I think it's getting a little better. TD has been great for us. And obviously one of the things that we did to overcome some of this pitfall is to actually have our own mutual fund that allows us to not have to deal with a lot of those problems.
I think that's an interesting point. I wanted to stress that again because you and I have chatted about this before, Randy. I'm not sure if we've really brought it up on the show too many times, but if you as a retail customer, listener, go to firm X, Schwab, or let's say TD, and with $20,000 or $200,000 and open up a retail options trading account, you're going to get a lot of advanced functionality, a lot of great tools. If Randy or some other advisor goes in there with $2 or $20 or $200 million, you're going to get some antiquated thing from 10 years ago, and you have to rely on Excel spreadsheets. It's a mind-boggling scenario, but it still unfolds day to day, whereas the advisor who's bringing a substantial number of assets to these firms, because I think, like you imply, they still don't really stress the options that much, and they haven't integrated a lot of their systems behind the scenes. These advisors are routed through essentially, for lack of a better word, the advisor ghetto in terms of tools and functionality. Whereas retail, these firms learned a long time ago that retail tools were a selling point for them. So they've devoted a lot of resources to improving those tools and marketing them as such. Whereas the advisors, that hasn't really been as big of a selling point for them. It's other things that have driven the advisor business to them. So they haven't really had the incentive, or at least the perceived incentive, to invest the same amount of money in the advisor tools. Hence, guys like Randy are stuck using some pretty outdated stuff, whereas, your Aunt Irma from Iowa with $20,000 at TD or Schwab is getting much better access to some tools.
Mark, one of the things that we've done additionally to overcome some of these problems with the actual platforms themselves is we've developed a lot of our own proprietary software to really kind of do an end around this atrocious software. So that's one of the other things that we've done to really kind of fix the problem. It's easier for us to develop our own software than to wait for these guys to get around to doing it at some point. That's
both good and a sad commentary on the business in and of itself, Randy, that you have to take the ball in your own hands to do it. Maybe you should open up a tech vendor division, Swan Technology, and start licensing these to some other advisors who want to go down the same road you do and are tired of waiting for firms like TD and Schwab to get their act together.
Well, we do actually license some of our software in certain circumstances, and so yes, there's an opportunity there, definitely.
All right, I'll toss it to you for one last quick comment here, Mr. Kavanaugh. What say you to our friend, Mr. Sullivan, and his question?
Yeah, it's an interesting question. I guess they haven't been around as long, and the incentive from a business angle for the bigger boys that have been around longer than options, they're looking for a carrot to say, show me how this helps my business. And 2008 probably didn't help the bigger companies because they see it as a risk. They see an unsecured account as something that doesn't happen in the stock market, meaning an account that uses leverage and sells a put and can actually lose more than what's in the account. If an account has $100,000 with $400,000 at risk, and the account ends up losing $50,000 more than what is in the account, that scares the established firms that have been around for a while. And unless somebody can make a compelling business argument that this is the entire business world coming in to trade and execute options, the companies that are established might just say, meh. Yeah, I don't really necessarily think this is something we care that much about. Some firms care a little bit more than others. I've had great experiences with the bigger firms, but it is antiquated, like Mark said. I mean, if I come in as a $50,000 retail trader that's trading 1,000 contracts a month, I've got some pretty robust tools. I can execute whatever I want. It gets a little bit more difficult as you go up the ladder if you're, like Randy's doing an SMA execution on overlay strategies. If you got 1,000 accounts and you're trading 25,000 contracts on a 10-point spread, that gets a little hairy for the online guys.
I think that's funny. I don't think a lot of our listeners really get that there's such a schism in the tools for the different uses, and I think that probably would blow their mind when they actually see what you guys have to work with on a regular basis. Eric, I will just say really quickly that I am kind of surprised and pleased to hear that you say that the Morningstar show, the advisor show, actually had some options representation. Because I was there last year. I, of course, missed it this year. And last year, it was essentially a wasteland from an options perspective. So I'm very glad to hear that perhaps they are diverting some more resources towards this because, of course, Morningstar, a big name in the advisor research space. And if they're not really actively participating in options, a lot of their clients aren't really going to as well. Speaking of their clients, next up, we have a question from Mr. Thomas Folk. He is a CFP. Not sure where, he didn't include that, but nice to know our CFPs are writing in and listening to the show. And he writes, most of my clients invest through retirement accounts. Can I trade options in these accounts? If so, what strategies can I pursue? This is a bit of a layup question, so I will toss it to you, Eric, seeing you're coming in, beaming in the farthest, and you must get this question about 8 times a day. Why don't you walk Mr. Folk through what he can use options or option strategies he can implement in a retirement account?
Well, it's interesting. Not all firms allow advisors or retail clients the approval process to use overlays or options in a retirement account. But one of the things that Thomas Folk, who is a CFP, and I should just put an endorsement out there for the OIC website, we do offer continuing education for not only IMCA accredited advisors but also CFP advisors. So they can do that on the optionseducation.org website. But I would comment to Tom on this question that one of the interesting things about qualified accounts is that if you as an advisor haven't recharacterized, but actually you've taken a traditional IRA account and moved it into a Roth for your client, you can now sell out of the money calls or do cash secured puts. And in a Roth IRA account, up to this day, until the IRS will decide to change it, distributions from Roth IRA accounts are tax-free. So utilizing overlay strategies in a Roth qualified account allows you to implement these strategies and then take distributions that are tax-free. I'll let Randy and Mike elaborate a little bit more, but I think that is an area that advisors as well as retail clients should be taking a look at if they do have Roth IRA accounts in their whole asset allocation mix.
This is Randy. I've just found there's a big disparity between what firms will allow you to do. So I think you have to go firm by firm in terms of what type of strategies you would like to do. I think that's all I'd add.
Yeah, my only comment to this is I think you got to look at the actual rules of the New York Stock Exchange and the SROs versus what firms are actually allowing their clients to do. So if it's a more conservative firm, they may only let you trade a covered call in an IRA or a Roth IRA or any kind of qualified account, and they won't let you trade cash secured puts, which we all know the risk profiles are the same on a cash secured put and a covered call. There are really no New York Stock Exchange or SRO rules that prohibit any type of option trade in an IRA with the exception of two: a levered or non-cash secured put and a naked call. Everything else you can do in an IRA. If your brokerage firm doesn't allow that, it's not because it's not allowed. It's because your brokerage firm doesn't want the unsecured risk of a market going higher or lower, where somebody's using leverage and they could have an account go debit. And that's my explanation.
It is very much a shame that we are in this siloed landscape where it's still beholden on the individual end user, the end advisor, to do this research and find the firm X that allows them to do strategy Y, but not strategy Z. It's kind of absurd, particularly when you're talking about things like covered calls versus cash secured puts, because as we've discussed on this show, they are the same thing. But it is interesting. I think, Eric, you make a good point. People think of the Roths as tax-deferred appreciation or tax-free appreciation, essentially. But they don't think about if you're doing option strategies in there, you're getting also all of that income generation, essentially tax-free. That is very much an attractive prospect. So if you're a covered call writer, you want to take that into your Roth IRA. That makes that strategy that much more attractive for you, the financial advisor, or even the end client who wants to propose that strategy to your advisor. All right, last up, we have a question here from Nathan Phillips, and it's an interesting one, very timely. He says, I have several clients with odd lot positions in Apple. I've toyed with using options in the past, but it never made sense given the size of the positions. But the launch of the new mini Apple products has piqued my curiosity. Are these products the same as regular options, only with a reduced notional value? Are there any nuances or hidden issues I should be aware of before I consider using these for my clients? Thanks for this program. I learn something new every episode. Well, Mr. Nathan Phillips, I'm glad we could provide a little bit of education for you on the show. This is a great question. Of course, he's referring listeners to the new mini options that were just launched back in March. So they are still relatively new, only been around about 3 months. And they're only listed on a few products. He mentions Apple. There's also Google and SPY and GLD and I believe a few others. So they're listed on a handful of very large liquid products. And they were constructed and designed with this exact use case in mind, Nathan. They were designed for people trading expensive stocks like Apple, or perhaps like Apple used to be, still pricey, but not as pricey as it once was, and Google and all these other big names that are very expensive. So people end up buying 10 shares instead of 100. So what do you do then when you have 10 shares of an underlying stock and want to write a covered call? Guess what? You can't, because you're writing a covered call on 100 shares, and now you have this naked short 90 share position that your broker will probably take a dim view of and put a lot of margin away on your account to do that. So, and also there's the risk profile of that, and it's just not a desirable scenario. So people in this position were left holding the bag, as it were, from an options perspective. They simply couldn't trade them. Now we have these minis, and it opens up a lot of interesting scenarios, but perhaps with a few caveats. And before I keep going, I'll let Mr. Kavanaugh dive in first. First off, I know you have in the past had a lot of clients who've traded Apple. Have any of them expressed any interest in these minis? And what's your take on the minis so far?
We have not had any interest expressed in the minis. I see it as, I grew up in a mini exchange in Chicago called the Mid-Am Exchange, where their big contract was a mini bond contract in the futures markets. And I mean, it was basically around for people that, was an entree into the market, somebody that didn't have as much money to speculate or was more conservative or just wanted to learn how to trade or how to invest. It was a great product. Outside of that, I don't see many contracts ever really taking off when a big one exists, with a couple of minor exceptions like the E-mini S&P minis. We could go into a 2-hour dissertation about why the E-mini S&P minis were successful and no real other minis have taken off. But I don't know. My thoughts have always been that on a stock, getting a mini, it's just to try to get more people into the market. I think people are interested in Apple, they buy Apple. But I could be wrong. My experience hasn't shown. I haven't been watching it at all because we don't have any clients. So I haven't been watching the volumes. If that's, a counter, maybe people are interested in, buying a tenth of a stock instead of paying, $400 or $500 for a stock. They're interested at $40 or $50 on the mini. I don't know. But my experience is kind of lean towards me saying I'll trade the big contract.
Speaking of the big contract, now, Randy, of course, you're looking at a little bit the opposite end of the spectrum here from the minis. These minis are obviously aimed at the very small retail client who wants to trade a smaller position. You're putting on larger positions for your overlay and whatnot. So you're not really using the minis. At least I would be surprised if you were to any substantial degree. But what's your take on this product so far? It's only been a few months. What we're seeing out there in terms of size, liquidity, and the use case for these products. So what's your overall view here on the minis to date?
Well, I would just say that time will tell to see whether or not these guys can be successful or not, but I do agree it's a good entree for some people that have smaller lots. But we obviously do not use anything like this in our core strategy, so I don't have anything else to add to that.
Eric, I'll throw the last one over to you. And I know you deal with advisors on a day-to-day basis. Are you seeing much interest in these minis from these advisors on behalf of their clients who may have these odd lot positions? And then B, what's your overall take on these products so far?
Yeah, I'll answer the question. I might differ from my opinion with Mr. Kavanaugh for the first time. Mainly due to the fact that Mike still wears a members-only jacket and uses a Sony Walkman, and I think he's got an 8-track in his car, if I recall correctly. So, the fact that bigger isn't always better, and part of the thinking behind the introduction of this recent mini option started in March is that look, we know regular option contracts cover 100 shares of the underlying. Minis cover 10 shares per contract. But what's interesting is we've seen a blossoming growth in the ETF world. And so, you have, actively traded stocks and ETFs like Apple, Amazon, Google, GLD, SPY. And so the mini comes into play also for the retail client that might want to dip their foot in the pool, by not buying 100 shares, but doing a fractional. And I think that where the mini comes into play for advisors is it presents sort of this flexibility for the client with these higher price securities. I think that's great. And a way to do, sort of maybe a greater level of customization. So, again, except for the size, Mark, mini options operate just like regular options, same strike price, intervals, bid offer spreads, expiration dates. However, again, it's that total value per contract that's just 1/10. So I think that, one of the interesting things is we do have a video and PowerPoint on the website at optionseducation.org. So if any of the listeners want to go on there and just learn a little bit more before they dive into it, I think that's great. And, we're seeing more volume. I think that advisors always are a little bit reticent in the beginning. They were with mutual funds back in the 80s. They were with ETFs in the 90s. And look how they've integrated those two tremendously large products into the way that they formulate a client's overall asset mix. And so I think with minis, the exchanges, the 11 that I represent, soon to be 12, as well as the OCC who I represent, they're hearing the feedback from their constituents And with that feedback is the reason of introducing a new type of vehicle that institutions, retail, and advisors can utilize.
You know, these minis are an interesting product, and I agree with everything you guys have said. It's all they're all very, very theoretically intriguing. Of course, they were announced pretty much at your conference last year, Eric, the OIC conference. That's where we saw the first initial competing product forms of these minis. They essentially launched less than a year later, this past March, so that is a pretty quick turnaround from an options regulatory new product approval standpoint. Going from April to March and having a product in the marketplace is pretty quick. And during that time, from the OIC of, 2012, all the way through till March, we saw a lot of interest and a lot of buildup going into these products, how these minis are really going to turn a lot of different things around. They're going to bring retail back into the fold. They're going to explode volume in products like Apple and other places where they're listed, and they were really being hyped to a great degree in the option space. Now, fast forward a few months post-launch, I think a lot of people have looked back and seen the minis. They've done all right, but it certainly, I don't think, has lived up to a lot of people's expectations. Just to address your specific questions really quick, Nathan, you're right. It is just a 1/10 size contract. Everything else is pretty much the same. I would just caution you to go take a look at the markets in these products before you bring your clients into them, because that's where we've had some people expressing a little bit of shock. A lot of liquidity providers, like a lot of advisors, have been reticent to dive into these products until they see some volume. It's a bit of a catch-22. Liquidity providers don't like to jump in until there's volume, but they're the ones who bring the volume. So it's kind of a bit of the minis are caught in that catch-22 right now. So as a result, we're seeing spreads that are still wider than the big contracts. So in order to get into and out of minis, you really are going to pay a premium to do that. So you really have to want to put that position on. The spreads have shrunk a bit since the launch, so they're not as bad as they were a few months ago, but they still are, in most cases, still wider than the big product. And also take into account that a lot of brokers still really haven't gotten their hands around how to price these things effectively. So you're still paying full ticket charges for these trades, and you're paying full commissions. And if you, as a lot of people like to do, try to combine, let's say, 5 regular size contracts with 10 minis, guess what? You're paying a ticket charge on each of those trades plus the commissions. So it's an expensive prospect from a commission standpoint and from a spread standpoint. So if you're thinking about getting into these, Nathan, I would just encourage you to be cognizant of that, because it really can impact the profitability of your strategies. But if you see all that stuff and you're okay with the spreads, and maybe you work a decent limit offer and you get a good execution somewhere in the midpoint, these can be very effective products for your clients, because at the end of the day, it's this or nothing. And so if you're looking to generate some income or hedge an odd position in Apple, this is pretty much the only game in town right now. So great question, Nathan, and thanks to everyone else who wrote in today. That's unfortunately all the time we have for this episode of The Advisor's Option, but I want to thank all of my cohorts here for joining me on the show today. Maybe we'll mix it up. Mr. Eric, since you are beaming in from the farthest away, we'll let you go first yet again. Give our listeners a little bit of an update on what you have cooking over there at the OIC Advisor website and what they could find that may interest them over there.
Well, Mark, I'm happy to say that you mentioned New Orleans last year when Randy and Mike were on a panel with you, and we had the CBOE host a conference this year in Las Vegas. Well, the Wealth Advisors Summit will be repeating itself from New Orleans 2012. We will be organizing an event, a one-day event with high-end advisors at the CBOE. The date is slated for September 25th. We'll have more information to provide to Options Insider Radio, but I just want to let your listeners know that the Wealth Advisors Summit will be having its second annual in Chicago, hosted at the CBOE. I also should let advisors know that I'm fortunate enough to have Randy on the panel next month in July at the Alts Innovative Conference, which will be in Denver the third week of July. Randy, along with 2 other portfolio managers from other overlay disciplined firms, will be out there as well. And as usual, I just give a shout out to my wonderful team at the OIC, including the Investor Services line. That's the 888 options number. And you can also find all updated things about the options world at optionseducation.org.
All right, Mr. Cott, thank you for joining us. I encourage you, all of our listeners, to head on over there to the website and check out all the great research and studies and analysis and tools that you guys offer for the advisors, all free of charge. If you're thinking about dipping your toe in the options waters, then optionseducation.org is a great place for you to start. And you mentioned Randy making some appearances at some upcoming conferences with you, Eric. Randy, what else do you have cooking over there in the hopper at Swan Wealth Advisors that may interest our listening audience?
That was the thunder that I was going to talk about, but we've got some other conferences that we're going to be doing over the next couple of months. So I think the best thing to do for any interested people that would like to know what we're going on is go check out our website. We post that stuff regularly at swanwealthadvisors.com.
And, of course, they can go there and get updates on the mutual fund and all the other things you have cooking over there in the hopper, as well as perhaps get a chance to see Randy in person at one of his many upcoming appearances. So check it out, swanwealthadvisors.com, and you could see for yourself what they have cooking over there. And speaking of cooking, last but certainly not least, we are also joined yet again, the Skype gods have smiled upon us yet again, to bring back good old Mr. Mike Cavanaugh for one final tip of the old hat. Mr. Cavanaugh, what is going on in the land of RCM asset management that may interest our listening audience?
I'm going to be hosting a live seminar in September at the Chicago Board Options Exchange for advisors that will give continuing ed credit. We know how much we love those continuing ed credits, and just going to talk about how to employ option strategies in your portfolio if you're an advisor. So if anybody's interested in that, I can send the information over to Mark. He can post it on his website. I can send a carrier pigeon to your office, however you want me to get you the information. But I'm looking forward to that seminar in September.
Well,
that's what's going on.
Well, thank you for that, Mr. Cavanaugh. And, of course, check out, like I mentioned at the top of the show, check out our latest additions to the Options Insider Radio Network, including the Wide World of Options, the Options News Rundown, and all the other great programs you can find by surfing on over to theoptionsinsider.com. Of course, you can read all of our great unusual activity alerts and our education and analysis and our breaking news on the options market. A lot of great stuff over there, including all the archived episodes of this program. So if you miss an episode that goes back a few months, surf on over to the website and check it out right there. I think you'll like what you'll find. On behalf of Eric and Randy and Mike and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.